Welcome to HipMojo number 18, special plaid edition. Proof that we don't really coordinate what we're going to wear that day, but that's fine. All right, so lots to talk about, CT.
All right, you want to dive in? I have a question for you, Ash.
Sure.
Greed, is greed good?
You know, I'm really like a softie because my answer to everything is it depends. And I think if ever...
I think we both do that.
Yeah, but I think if ever there's an answer that is it depends, it's for this one. Because yes, greed is good sometimes. I think if you have, profit as some kind of yardstick to see whether or not the business you're running or the project you're running should be a project, should be a going concern, I think in that sense it's a very fair way to measure success. I think the problem is when you put profit, when you put profit ahead of people, ahead of quality, ahead of service. Alec Baldwin goes crazy, right or wrong. He does make, I can't believe I'm going to say this, but then he goes on Huffington Post to complain about the service he got, basically getting kicked out of American Airlines for being on his phone after the gate was closed. He's wrong about that. He should have been off. But he did make a point. He's like, look at the difference between not literally American Airlines, the company, but US-based carriers and airlines and European airlines. He's like, why is it that in the US, it's like we use 9/11 as an excuse to basically just cut out every level of service and basically make the service so crappy that you feel you're an animal. But over in Europe and in Asia, the carriers in the same business still give you a certain level of service. I think that's just because in North America and the US in particular, profit is so paramount that, yeah, it basically just distorts any sense of reality and you get shoddy products, you get crappy service. And consumers then, we become conditioned like Pavlovian dogs that we take that as, yeah, it's normal that, we get no service and things suck.
But let's
Good
take
morning
this back
to you all.
Let's try to take this back to the whole world of tech. I guess I should have qualified the question. We're talking specifically of like, do you think greed is rewarded in the tech industry, specifically in relation to IPOs and that kind of thing?
Yeah, I mean, okay, so...
Because you look at IPOs and stock starts off in one place and it just goes down after that.
Okay, well, IPOs are separate from the question of does technology and investors in the market reward greed and more bad behavior? I think the answer to both is yes, but the IPOs are a bit different because who is manifesting that greed. Let's start off. The article that I wrote on TechCrunch struck a nerve because the comments were like, oh my God. So what happened was during the week, basically a few, other CEOs that I talk to, we always joke that I'm basically writing the same article, just spinning it differently. Content is king, but without distribution, it's not really all that worthwhile, That's usually the theme overriding of my article. So I start covering other angles, and in this article, basically I saw Facebook have its latest privacy issue. I see Google having its latest issue. We see, Yelp doing whatever to piss people off. We see other companies, basically upsetting people, pushing the envelope to maximize value, to maximize profits. So I just basically said, it's really funny that we're basically coming on not that we're coming on. We just celebrated the 20-year anniversary of the inventor of the World Wide Web, Tim Berners-Lee, not patenting his invention. If he would have just made that decision on that morning, you know what, I'm going to patent this baby, he would have owned the web. Maybe the web would have been very different. Maybe the web would have sucked and we would have had something totally different. But the bottom line is the web started off because one guy decided to look at the bigger picture and not put greed ahead of the greater good. As utopian and naive as that might sound, it led to a lot of good things.
And it worked.
But then 20 years later, and not even 20 years later, 10 years later, you saw the first wave after the initial Yahoo and eBay. You really saw that the markets, investors, and public markets were really rewarding bad behavior. And I start off by saying, after the NASDAQ crash, you saw these companies like Gator, Gain, Claria, or When, which allegedly basically hijacked your computer, ran ads, ran pop-ups up the wazoo. It was annoying as hell. You had this adware, spyware kind of phenomenon. And I said, shockingly, these companies were not the pariah. They were actually rewarded through venture capital funding and all that. And then I said, even though those companies were doing bad things in a certain way, if you fast forward 5, 10 years, I'm not saying Google doesn't do any good. Google's done a lot of good. And but Google is basically targeting you based on your behavior and your analysis, whereas
they found a way to do it without hijacking your computer.
Exactly. So I'm just saying, obviously Google, we're not saying Google's a bad company. I'm not even saying Facebook's a bad company. These really are great companies that are doing great things. But I'm like, if you take a look at the macro level, investors, public markets are rewarding bad behavior. They are rewarding greed. And I'm just saying, I'm drawing a parallel. I'm not saying business is bad. I'm a freaking entrepreneur. I'm a business person first and foremost. And like, if you look at all the things I do, I'm not some kind of artsy-fartsy academic who's like, oh my God, greed is bad. But I'm just saying it's very ironic that how much things have changed. And then I was like, we got a question regarding IPOs, so I said, which we'll cover in the email of the week. But then I said, well, what's happened with the IPOs this year? And if you take a look, LinkedIn traded at 84 when it went public. It's now at 74. Demand Media started at 22. It's now at 7. Groupon was at 26. It's now at 21. Pandora was at 17. It's now at 11. And Zynga is going to go public December 16th. So if you take a look at the 4 big IPOs this year, they all started high. They're now trading low. What does that say? Well, it shows that there's greed still in the market.
Well, how much of that, though, isn't it possible that, especially in the world of the web where technology is new and blah, 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 maybe people don't actually know how to evaluate a certain company or product because it's doing something that hasn't really been done before? Like in the case of like LinkedIn, I think it was
great company, great service.
Yeah, now, but I believe it was like probably the first social network to go public.
Yep. And the most useful, frankly.
And the most useful. But how do we evaluate a social network if one has never gone public before?
Okay, so fair enough. That's good. I mean, when you go public, the main way is you look at comparables, other companies in the space, either publicly traded or previously that went public, and you sort of compare them. Now, LinkedIn is actually a bit easier to value because LinkedIn still gets the majority of its revenue, its recurring subscriptions. So I actually think LinkedIn is the anomaly because it's a company that actually makes money through charging people and businesses for a membership. So it's an annuity. It's very easy to evaluate annuity revenue stream vis-a-vis advertising, which goes up and down. But I hear your point that if you take a look at when Facebook goes IPO next year in April of 2012. You could say, well, what was LinkedIn worth, and what did Pandora go public at, et cetera, et cetera. Listen, valuations are always, it's a racket. Historically, what happens is the bankers, God bless them, they tell the entrepreneur, the founder, the management team, and the investors, you guys maybe should go at a $5 billion valuation, which implies whatever, let's say $20 per share. But if that's the fair value, the stock won't pop. The stock will stay at 20. And that's not good for PR. So why don't you price it at $10?
And then
it doubles. But what happens is then the founders and the management team miss out that difference between 10 and 20. So they leave money on the table. The investors get it. So at the end of the day, business is a racket, the same way that war is a racket. I'm just saying, sometimes you do want to go home and take a shower after you realize you're in business, but the overriding conclusion was, I guess the web is no different than business. The same way that business is driven by, greed and profit and stuff like that, the web is fundamentally, despite its initial very utopian, idealistic birth, has become just as normalized as the web. Now, as business. Now, I do think, though, that is there a case, like companies that when you look at the stakeholders, do companies, and this is maybe a theme for a follow-up segment, some other show, it's worth asking, do companies that put the stakeholders, such as clients and employees, ahead of, let's say, shareholders or managers or whatever, do those companies go on to be successful? Southwest, historically, has always put clients and employees ahead of, let's say, shareholders, and it's a great company because of that. But, anyway.
You know what, just to go back quickly to the web and putting clients first ahead of shareholders, I think, and you're going to hate me for this, I think part of that is putting the product first, because the product's what goes to your customers or clients. There's countless examples of companies, as they grow, they actually start getting really bad at what they started off doing, but they're money rich. So their new CEO comes in, and his or her plan is to go around and just buy up other companies. And he's rewarded for this kind of greed, going around buying up a bunch of things in an industry that the company has no experience in. And then what happens a couple of years down the line, they end up stretched too thin, they're too much in debt, and they start selling off these companies, and the company's original stock is in the tank because instead of focusing on doing what the company was supposed to do, they decided to become nothing more than a glorified investment portfolio, and that's what their CEO was. He was a portfolio manager. But all too often, boards, like to appoint CEOs that do that kind of thing.
Yeah, the irony of that is, and we'll close off on this and move to segment 2, the irony is you see it's very cyclical. You go through a period where it's all about acquisitions, buy. And then you then see the reverse happening, which is like, oh my God, you got to spin this off. You got to spin that off. We're going to focus on this and that, our core competency. It is what it is. Okay, we're going to take a short break and come back and discuss the wonderful world of print and their follies and adventures. We'll be right back.